Hello, hello. Welcome everyone in the Multifamily Deal Structuring Monday. Today our guest is Daniel Twito. Daniel is a Texas licensed realtor, LMAX Realty LLC, and he has 9 years of experience in real estate investing, buying, selling, and self-managing smaller multifamily property. He has 3 years of experience in the commercial multifamily space, mainly in the acquisition and management process. Started buying multifamily properties in Charleston, South Carolina in 2012 and currently a general partner in 215 units in Dallas Fort Worth MSA. So he is a CEO for Live Enjoy Residential. Owners are managing around 3,900 plus units, and he spent 9 years serving as a commissioned officer in U.S. Naval Reserve. Here's the interview. Hi, Danielle. Welcome to the first GP Multifamily Deal Structuring, where we will discuss all about your GP Multifamily transaction. Thank you for joining us here in the show.
Hey, yeah, thanks for having me, Jeff. Glad to be here.
Yeah, thanks. Then, tell us about yourself.
I'm a recovering engineer. I went to school at the Merchant Marine Academy in New York and spent 5 years professionally working on ships, deep sea, and oil rigs in the Gulf of Mexico, and then was working on investing in real estate at the time and finding a way to grow my real estate side. So I started investing in 2012 in smaller residential, and in 2018 I started to get a little more educated. I joined a couple of education companies and learned a little bit more about multifamily and syndication, and ever since in 2018 started to grow in the multifamily world. So since then, my first syndication started passive, 310 units, and then did my first syndication last June, which was 160 units with a couple of partners. And then we just closed on a 55 unit deal here in Dallas Fort Worth. Started doing property management January 1st of this year, and then now we're under contract for a little bigger deal here in DFW. So that's the short timeline of kind of how I got into real estate.
Okay, that's nice. Like at least, so you jump first into the commercial right away, right? I guess.
After having had some success in smaller residential and realizing that the power of real estate, and that was theoretically, right, you write down, you do some modeling and analysis of the deal and stuff, but then when you actually are able to gain the knowledge and experience after you implement the business plan and are able to achieve what you thought you were, then you get a little more confidence and you kind of know what you can do. So in 2018, when I started to get educated about commercial real estate, like larger multifamily, of course, you're initially you're thinking, oh, I'd like to do a duplex or a quadplex, or I'd like to do 8 units or 12 units. I mean, really, that's at the time when you first start looking into it, you're just excited to maybe buy a little larger property, and then slowly, as you gain confidence and learn the right information and how to implement the business plan and stuff like that, then at least for me, I started to just really realize that with the right team, a lot of this stuff is done with really strong partners, really strong teams, and you may not have all the experience or the track record or capital, but there may be some value that you can add to the partners that that way you can also participate and do something in commercial real estate. So that's what kind of I leveraged as best I could, what values I could bring to some people that were more experienced than me, and so in my engineering mind, as soon as I kind of started to model and look at real estate and how residential real estate, multifamily specifically, I just it made sense to me, and so that's why I jumped into it. And fortunately, I had an opportunity to co-sponsor a deal early on, as I started getting into it and getting some momentum that way. So, yeah.
And that's nice. Then currently, like, where are you located again?
So, yeah, our company is in Plano, Texas. I'm actually right at the office right now. But yeah, I moved to Dallas in 2016. So I'm originally from Iowa and went to school in New York. And so then, but all the partners and all the business has so far been in Dallas, Fort Worth, in this area.
Let's talk about your the
Um,
source of the deal, like for what's those brokers coming from broker or off market? Yeah.
Yeah, so most of the commercial real estate transactions that are happening, let's say over 75 units or over 100 units are mostly coming from brokers. I mean, in most cases, it's a broker's relationship is going to be talking to a seller, and so you're trying to create a relationship with the broker that you might get the first opportunity to look at it, or even at the best and final stage that the broker has enough trust in you that you can close the deal. A lot of times people are wanting to buy a commercial real estate deal or a little bigger deal, but the question that a broker has to understand is that can you close? Like, how are you going to fund the deal and stuff like that. So that's that's part of the process for a broker, even to do some due diligence on a buyer and make sure that the seller is being taken care of. So the first deal that we closed last year was 160 units in Irving, Texas. And that deal was listed on the market. And so we took a look at it. And I think it was marketed maybe starting in March. And they kind of go through, a process, invest in final, and all these things it takes a little time. And then we ended up closing June 12th last year. And the seller was doing like a 1031 out of it. So we ended up delaying closing a couple of weeks for some to give them a little flexibility in the exiting of the deal. So then the next deal that we fast forward, we've been underwriting a lot of deals and starting the property management company at the same time, and then COVID happened, so there was a little uncertainty, and but we had a 55 unit deal that we closed just recently here it's in North Dallas. It's in Plano ISD. So Plano school district is one of the better school districts, a pretty nice North Dallas suburb. So we that one was an off-market deal. So that was not listed by the broker, but it was somebody that we had been talking to previously about other deals. And typically when you're talking to a broker, and maybe offering on his deals and getting close to the deals, and they kind of understand what your criteria is and what you're looking for, you can create that, relationship with the broker and sometimes they have an off-market deal perhaps. And right now, off-market is a little misleading because off-market, depending on the relationship you have with a broker, it may be that you're getting a look at something that not a lot of people have looked at, but there's also the possibility that the seller is just wanting to know what type of interest is out there, what people are willing to pay for the property, but they don't actually want to sell. So there's, a fine line between a real a true off-market deal and an off-market deal that everybody has seen. So not really off-market, but you'd like to think so. So this was truly an off-market deal. They're whisper price. They were asking $5 million for the deals, 55 units in North Dallas, all one bedrooms, and comparable properties. So 1980s vintage, comparable properties in the area had traded for 92, 95, $100,000 per door. And we were able to come to a kind of final purchase price right at 77,000 per door. So ended up being, I kind of said, it was about a $16,000 discount from what other comparable properties were selling for. And mostly that was from just not having the competition of other people, the relationship we had with the broker, and then the the property, really the property, which is the value, which is the opportunity in the deal, is that it was being, it was an out-of-state owner that was being locally managed, self-managed, and very poorly, and that's not, that's the opportunity for us, right? So we have an in-house property management company that we own, and so we can run operations, we have a team for that, and so that's some of the value add on that property, right? We're gonna do some more interior rehab, and I would consider North Dallas and the Plano ISD to be a pretty strong submarket, and for similar one bedrooms in the Irving market, let's say we're getting $850 per month in rent, and we were buying this 55 unit deal, and their average rent was let's say $749, and so we underwrote that we could get the rent to, at a minimum, $799, which is at least in DFW, $799 for a one bedroom. That's a very affordable rent. There's a lot of people that can afford rent, and there's a lot of people that want to move into this area so they can, have their kids go to this school district and stuff like that. So that was kind of the opportunity that we saw in the deal, and stuff like that. So the business plan is probably about a 2-year business plan with a 2.5 year business plan, and then the loan we got was kind of similarly no zero prepayment after 2 years. So then we'll just look to exit after that once we do some interior upgrades and some other value add stuff. So
okay, yeah, that's nice. Then what's the story of the property? Like any reason for the seller? I know, like you mentioned, I think 1031 for that other property, I guess.
So in commercial real estate, a lot of times people are wondering or asking the question, why is the seller selling? And and in single family, in a lot of cases for single family, the reason that the seller sells is there's got to be some underlying issue or some reason why they're selling. If they're not making the cash flow, why are they selling? There's always a lot of questions behind that. In commercial real estate, there are some questions about why the seller is selling, but in a lot of cases, it's because they've implemented their business plan. So when you go into a commercial real estate transaction, or when you go to buy a property, you have a pretty set goal and business plan. If you, like, let's say you go into a property and you estimate this, for instance, there's 200 units and you want to upgrade 100 of the units, right? So you budget a CapEx for $1 million or $1.2 million or 1.2 million or something, or 500,000. Well, if you do the value add that you had written your business plan for, and you get to the end and it's year 5 or year 4, year 5, 6, whatever it is, or 3, your options are, you can refinance the deal, you can put a supplemental loan on the deal, you could sell the deal. So there's a lot of different, things there. You have options at that point, but that's kind of why, in commercial real estate, there's always transactions happening, and there's always, deals that are trading, and people are selling and buying and things like that, because, it's not always that it's distressed. It's not always that it's, mismanaged, or there's some problem, or there's an issue. It just may be time to get the money out, and there may be investors involved, and investors, even if they're cash flowing, let's say 8 or 10 or 12% per year or something like that, at some point the investors may want their money back. They may want to go and enjoy some of the money or whatever. So there's a lot of different factors involved, for why sellers sell their properties. So in the case of the first deal, the sellers had implemented their business plan, and it was actually owned by a bank. It was owned by a bank since 2012. So they had done the business plan. They were selling off, all their Texas real estate. They had sold off slowly a lot of their other states' real estate, and they were ready to go from being bank owned to selling it. And then the deal in North Dallas, the seller was looking to sell it off market for a little time, and he's had multiple of his projects on the market for for a little while. So he's been, trying to sell his portfolio slowly in Texas, and he's an out-of-state owner. And so just feels like he wants to maybe get the return.
Okay. So at least those are the two. Then for these two properties, were you able to get? I guess you were able to get the T12 and the rent roll for these two.
Yep. So in both these, we were able to get the T12 and rent roll, so we could underwrite the deals. So we had access to all the information, and when you're looking at a little bigger deal, it's important to get that information on. Until you have quite a bit of experience, you kind of know what's possible in an area without a rent roll on T12. If you're not able to get a T12 and a rent roll, you want to make sure you have a really good relationship with your property management company, so they can give you some budget, some sort of budget for the expenses, and some sort of budget for what payroll will look like, and then a market survey if you don't have a T12 or something. But generally on larger multifamily, you're gonna have those things.
Yeah. Then do you recall, like, was there any kind of some, not red flag, but something that needs to be taken a second look for the rent roll and the T12?
In the rent roll and the T12, you're always looking for any trends or any difference in what the broker is telling you and what is actually present in the rent roll. If there's a 1-bedroom unit and they're telling you it's supposed to be able to be rented out for $850, you want to verify that that's possible, through your own due diligence, right? Doing a market survey or something like that. So there weren't any real large red flags, but we were able to see, even though they were well occupied and things like that, just having conversations with the seller, the opportunity, and we knew the opportunity was going to be, basically, professional property management, being a little bit better on collections, and bumping the rents up, and taking a little more active role in the property. So, I guess the rent roll in T12, you're just wanting to verify all the line items match up, they make sense, and you can look at past deals you've done to verify some of that stuff, or just make sure that they're reasonable numbers. And and like I said, property management companies can oftentimes help with a pro forma or a budget for your expenses. So
okay. Then for these two properties, what was the original purchase price, or then how much were you able to get it for?
Yeah, that's a good question. So the one we bought last year in June 2019, so that was, I think the whisper price was $14.4 million. I think it was $14.4 million, and we ended up purchasing the property for $14.5 million. So it was highly competitive on that deal, and there were a lot of offers, and some of the groups that were part of the education companies, that teach syndication, there were a lot of people that were offering on the deal, and even after we had offered on the deal, there was a private equity company that came in. After we were already best in the final, after we were going through the interviews, the buyer to make sure they feel comfortable that they can close. And we were on the buyer interview, and they asked us, hey, we have a private equity company that's saying they can pay an extra $50,000. Are you willing to match that? And one of my partners was on the call, and he said, we've been doing business for a little while. He knew them pretty well, and he said, if it's not required, then we don't want to, but of course we're not going to lose a $14.5 million deal for $50,000. So that's kind of those are some of those last minute conversations can be the difference between getting it and not getting it. And so but to give you an example, like we bought that in in a year's time, we've distributed about around 8% cash flow to investors, and increased the income from 145,000 where we bought it to 163 per month, which
Yeah, that's huge.
if you look at a cap rate real quick in DFW, we're conservatively we've increased the value $1.5 to $2 million in a year's time. So overall it's gone really well. Of course, you don't know what you don't know. Everybody's looking to your underwriting as best you can and with your ability and things like that. So that's kind of how that one went. And then the off market deal was kind of the opposite. Like I had said, the whisper price was $5 million, and we ended up getting it for $4.25 million. So and that can be the power of the relationships and the people that you connect with, and in the commercial real estate world. So that's how that one went.
Okay, nice. Then what were the economic vacancy of the property when you bought it for these two?
Economic vacancy is about 7% in the first deal. And what I would say is, when you're purchasing the property and there's an agency loan, during the purchase process, the occupancy needs to stay stabilized and look good. And what you'll find is that when you close and you walk on the property, there may be some residents there that aren't paying, or there's always going to be something when you purchase a property. Sometimes it's larger things, and you're trying to uncover them through the inspection process, and so you can uncover as many unknowns as possible. But
Okay. Yeah.
but yeah.
Then then for the off market one, do you know like the economic vacancy for that 50? No, yeah.
Oh yeah.
50 units, yeah.
Yeah, economic vacancy. I was trying to remember. The economic vacancy in the one in North Dallas was similar, like 6%, 7%, and then you walk on the property kind of after close, and there's typically like 1 or 2 skips or something can happen or something like that. So that's why when you come on, you just want to be ready to take over day one, and even as the transition's happening, you want to be vetting any leases that they're leasing during the while you're under contract. You don't want them to be filling up your property with people that don't qualify, like that. So even things like that, because you're going to be the leases they sign in the month or 2 months before you taking over, you're still going to be required to honor. So if they're signing people up that don't qualify just because they want to fill it, there's some things you can do there. But yeah, typically I think on both it was about 5 to 7% economic vacancy. So pretty strong properties.
Okay, nice. Then how's the financing breakdown, if you recall, like for the property, in terms of the loan?
Agency debt on the deal we closed last year was about 4.07%.
Okay.
Fannie Mae Green program, which I think we initially underwrote for 4.3. So and everybody thought 4% last year was pretty good. Now we're getting 2.79 is the last term sheet I got for a bigger deal. But yeah, so the Fannie Mae, and then the one we closed here in North Dallas, that was a Freddie Mac SBL loan, and that interest rate was a little bit lower. I think we ended up with around a 3% interest rate on that. So you can kind of see agency debt for a stabilized deal it can be pretty strong loan terms, and the leverage on both was around like 71-72%. So we generally and I think even on the deal we closed last year, they had offered a little bit higher leverage, a little more proceeds, and just because we wanted to be stay conservative, and we had kind of underwrote for a certain level. We just felt comfortable. We didn't take all the proceeds that they were offering.
Oh, okay, yeah, that's good. So at least you have a lower LTV than lower. Yeah. Then,
right, we had a little
how,
more
yeah, what's the
LTV. So
terms? Yeah, what's the term on this one? Like how many years to pay, and also like, do you recall the amortization on this two loans?
yeah, they're amortizing over 30 years. The one we did last year is a 12-year term, Fannie Mae, and then the one that we closed in North Dallas is small balance, and I think it's a 5-year. It's 5 years with a couple of options to extend, and no prepayment after year 2.
Oh, nice.
So that kind of fits. You want to buy, you want to put the financing on that's going to fit your
Yeah.
business model, right? If you're planning
Yeah.
on holding a little longer term or anything like that. So I mean that we're looking at a deal right now, and similarly with some of the uncertainty in the market, we're just making sure that there's long-term, low rate fixed financing, just in case anything with the economy happens.
Yeah. I think this one is also good like that. Even it's say the 5 years, then you have because sometimes people overlook the prepayment, because sometimes it could be also hefty fee for the
Yeah,
prepayment. This is good, like at least, because most likely like all this value add, you hold it at least 2 years just to implement your business plan. Then after 2 years, you never know, someone might come in and buy it, and at least you don't need to pay any prepayment with this kind of structure of the loan. Yeah,
right,
that's a
right.
great idea. Yeah.
A lot of people are looking at, or have been looking at, floating rates recently, and just so they can avoid the prepayment penalties, because the last few years people have uh, standard practice has been, I think, fixed rate has been more of the better option, at least what people have been putting on their financing to be conservative, and now I think more people are looking at floating rate with a cap, so you can avoid some of those prepayments, because now that some of those deals, as the interest rates come down, that yield maintenance is actually going up quite a bit. So it's really it's not conducive to selling in 3 to 5 years if something like that happens. So you want to have you just kind of want to know what you want to do, and have multiple options on the exit.
Mm-hmm. Oh, nice, nice. Then, what's the capex budget that, if you recall, on this two property?
Let's see, the CapEx budget for the one that we closed last year. I don't think exactly. I think it's about 500,000,
Okay.
maybe 3,500. I think was the final number we came up with. For the 160 units. We did carports, interior units, some amenities, dog park, the green program, exterior lighting, LED, water conservation. So I think the all in was something, it was 596. I want to say it's 596 when we finally got to the last number. And normally when we budget a capex, there's a big cushion. There's a cushion for any unknowns, any things that could pop up that we don't exactly know for, and that's just being safe. If you're underwriting and you're trying to do your capex out of your operating budget, that's not a good idea. You want to be raising that money up front for capex, and the old adage is to raise a little more than you think is required. Raise a little more just in case anything happens. Have some reserves and stuff like that. So, that's kind of what we did for that. And then, very similarly for the 55 unit property, the capex budget is about $150,000, kind of $3,000 per unit, which is it's a pretty light value add in terms of like interior units and what we want to do on the property. So that's really plenty for that property to do what we're trying to do, because most of the upside, a lot of the upside is in the management, and then some other interior upgrades and things is will be there.
Yeah, then I think I believe you mentioned about that you have an in-house, so you're vertically integrated in terms of property management.
Yep.
Oh, nice.
Yeah, so we started the company last year and took over January 1st.
Yeah, because I think that's a good thing with the some people that don't want it, but I think the good thing with the vertically integrated is like you have more control because it's your employees or you have
Right. And it depends on, I think it depends on, what your goals are. But for us, it was the right decision to bring it in house, and it does give you a little bit more control on the day-to-day operations. And for something like a pandemic to happen or COVID, you can pivot and shift and make fast decisions that can really affect how well your properties perform. So you're able to implement those things, and then also on the business execution side, you're able to implement your strategy and your business plan that much faster when you're also operating on the day-to-day operations. That really makes a big difference. And then of course nobody's going to be nobody's watching your property like you're watching your property, right? It's your investor money, so
no one,
it's up to you. It's your responsibility. So you know
no one
that's why.
watches it like an owner. Yeah.
Right. So that's those are the reasons we took we wanted to do property management ourselves.
Okay. Then what's the investor split like when you structured this two deal?
Investor splits, they all vary. So we've done straight splits in the past, where the investors will participate as well as the deal sponsors on a straight split level. And typical straight splits range from, let's say the deal sponsor is taking 10% of the deal to deal sponsors taking 30% and investors getting 70%, kind of all depending on the deal sponsor's experience, track record, things like that. And then the deal we closed in North Dallas, so that was a similar straight split. And there was a little family office. And then the going forward just with coronavirus and causing the market to be have some uncertainty, we're moving to a preferred return model, which basically means that the investors will get paid first. So in a preferred return model, the investors get paid a 7 or 8 or 9% preferred return, and then generally there's a split, a split with the sponsors and the investors after that. And so that way, in some kind of a waterfall or something, where basically as the returns to the investors go up, then the deal sponsors will get compensated more. And it kind of, basically what it does is it aligns the deal sponsor and the investors, goals, right? The deal sponsor wants to do as good a job as they possibly can for the investors so that they have an opportunity on the upside in the deal, to, have some compensation themselves sometimes. So that's all based on the deal sponsor's skill, right? If you buy a deal that you don't buy it right, you could be working with a preferred return model. You could be working for 2 or 3 or 4 years, with no compensation. So you just, it puts a lot more of the risk on the deal sponsor as opposed to the investor. So that's kind of what we're moving to, so investors can feel a little more, just it's a little more risk averse for the investors.
Yeah. Then also you mentioned about the family office. So did you brought in like a family office in any of these two deals?
Just the one in. So the one we closed last year was just a typical syndication, and then the one we closed, the 55 unit deal, was somebody that we've known for a long time. That's done some smaller, kind of grown slowly, and they kind of have some contacts. We're able to raise some family office money, kind of, and bring it into the deal.
How does if you can share because for our listeners like who was interested like reaching out to the family office, how does that typical structure for a family office? Let's say, are they investing kind of as an LP, or how much kind of interest or share that they're getting? If you
So the terms for family office or any investor, it really depends on the deal and how much they're bringing into the deal, and how there's a lot of factors that come into play, and everybody's criteria is different. so there's and different timing and things like that. So as far as the structure goes, general structure might be, they might ask for some fees on the front side. They may ask for, some equity in the deal. They may ask for some clause that says like if, basically they call them bad boy carve outs, right? If you do something negligent or, they just want to protect their money. So if there's anything you do illegal or fraud or something like that, they're gonna, they want some carve out so they can take over management of the property. And but a lot of times if a family office will maybe bring 90% of the equity and then you bring 10% or something like that. So, and generally those come through relationships or you know that person for a long time and, something like that. And then they, typically you've done multiple deals already and they have a good, you have a good track record and stuff like that. And then you can approach them or they approach you or however that works. So.
Okay. But do you remember like in terms of this, so the 55 deal, so that's where the family office was partnered with you.
Right.
What was the split on them, or did they charge you like a fee upfront or on an equity, I guess, equity share?
Yeah. Typically on family office or deal structure and things like that, it's pretty standard. Like I said, like normally they're bringing 90% or 80% into the deal, and then we bring the rest. And sometimes there's fees, sometimes there's not fees. Everything is negotiable. Just like if you're talking to a broker or something like that, the whisper price, they can say whatever they want, but what you kind of negotiate or come up with your best purchase price or whatever is up to you. So that's kind of the same with any private equity or family office or anything. They can kind of give you a term sheet and say that they want whatever they want, but if it doesn't work for your underwriting or it doesn't work for your deal or something like that, then it may not work.
Okay. Yeah. Then I guess let's go with the what's the IRR or average cash on cash on these two deals that you have?
So the deal we closed last year, the cash on cash, we're projecting 9% and then a 15-year or a 15% annual return. And then on the one that we just closed, because it's more of a value play, it may not be as much cash flow for the 2 years. Maybe a little less cash flow, and then there'll be a larger return on the backside, probably somewhere around 15-20%.
Okay, so as a AAR kind of
a little more value play than the other one's a little bit hybrid, and so this one's a little more value.
Okay, then let's go to our next portion. Will be the due diligence portion. Anything that you can share, like in terms of what gotchas or that you have experienced in when doing due diligence in these two property? Any lessons learned? Or
if I were to give you the lesson, I would say is hire professionals. Because you may not have experience in inspections or due diligence personally, or you might think you can just walk on the property and kind of understand what's going on. But if you spend a little money on the front end and get, a really strong, let's say, construction contractor or somebody that has a team that can really look at, each piece of the property, it will save you a lot of, headache in the long run. So that would be a lesson learned. Just make sure that your team is, really strong and really solid. They know what they're doing, and vet them very hard. And then, they'll kind of, make sure that you are not getting into too much trouble on the property. Lessons learned, kind of from the first deal, the lesson learned was what the broker puts in the OM and what ends up being true on the property can be just a little bit different. They may say, that a certain number of units are upgraded and, generally it's pretty close, but there's always a little room for, and they're going off what the seller is telling them and things like that. So there's always just, typically there's going to be something in a transaction. There's always going to be something in the due diligence, something that comes up or something small or anything like that. So just, I would say maybe expect it, almost expect that there may be some small thing at the property that happens, kind of expect it, and then be pleasantly surprised if, everything goes smooth and everything's fine. That's kind of, as a syndicator, as a business owner, you're a problem solving, right? You're solving all the problems. So it's not that you're not going to have the problems. You're going to have the problems, but you just have to have the right team members to be able to know how to solve the problems. So that's really important when you're doing due diligence, for sure. So,
Then, do you see kind of any like deferred maintenance when you're working in the property, at least for these two deals? Like that is a big CapEx kind of, do we need a big CapEx budget for this because it either, let's say, you need to replace a roof or something?
No, we didn't have any roofs needing replaced, but boilers are, boilers or chillers or anything like that that's pretty large. We generally will try not to buy chiller properties, but boilers are going to be a very large CapEx item.
Yeah.
So, you're checking the age of it and how long it's going to last and things like that. Foundation, wiring, lenders are going to require certain older electrical systems to be replaced if it's aluminum or something like that. So you just want to be aware of, some of those larger CapEx items, but and then budget for them. If you need a new boiler and you need an extra $30,000 or $40,000 in your budget for that, you want to make sure that you're raising that money up front, as opposed to trying to, like I said, pay for it out of cash flow. That would be that would be a mistake for somebody to try to do that. So,
yeah. Did this properties like I know like you're saying to avoid chiller and boiler, but for this one, was it individually kind of their air conditioning for this property that you have, the 160?
Yep. So both properties were, pitched roof, individual HVAC,
nice.
boilers, systems like that. Yeah. So that's kind of what we tend to look for in better neighborhoods, and that's typically what we buy.
Okay. Then I guess the property management, you have it in-house. I guess like let's go to the capital raise. How much capital did you need to raise like for this deal?
The first deal was 4.5 million. So that was 160 units. We needed about 4.5 million in equity.
Yep. Then the second one, do you recall like how much?
Yeah, I think we needed about 1.3 million. I think
for the
1.3 million was the final number we needed for the 55 units to close.
Okay. Then how many days or weeks did it take like for the whole capital raise?
So for the 160 unit property, we raised the money in about 2 weeks. Once we had kind of done the due diligence and inspections and got, kind of got ready for it. And capital raising doesn't happen when you've got the property under contract. Typically, you want to have investors lined up for like a long time, and that happens, over a long period of time, with a track record. And so one of my partners started it about 12 years ago in single family, and slowly started to help people buy houses and single family, and bought some single family himself and grew that track record. And slowly, step by step, 60 units and 80 units, 100 units type thing. So when you get to 160 units, and we can raise 4.5 million in 2 weeks, it's a long, that's 12 years of experience and hard work getting to the level of, raising, 4.5 million in 2 weeks. So it just doesn't happen. It doesn't happen overnight. So then the other one, like we kind of mentioned, it was a family office. So that was, that conversation we'd had for a long time before that. So we were looking specifically for a property that kind of matched what they were looking for. to purchase. So that's that money was already available when we went to go and buy the property.
Okay, yeah, I think that's a good. And also, I think one thing to note also to the listeners, like when you're, I mean, because people they tend to, okay, maybe I can just go to the family office because it's easy money. But the thing is, you need to gain that trust from the family office. They will not just lend you money without you having track record. So
Yeah,
for everyone, it's
highly
not easy.
highly sophisticated people, right? They
Yeah, so it's
they
not
have
like
tons
an
of
easy.
experience. Yeah, they'll just,
Yeah.
if you say the wrong things, they'll just throw you away.
Yep. Yeah, it's not like oh yeah, I need to just build the rapport. The rapport
Right,
will not
right,
happen like a few days. It will be
right,
months. Try to
right.
gain the
Years, in a
yeah
lot of
years.
cases,
Yeah.
years, honestly. Yeah, talking and discussing, and then watching, and they'll let you kind of do 3, 4, 5, 6 deals, and
Yeah.
watch the track record, and then all of a sudden they'll contact you, kind of.
Yeah. Then I think once you gain the trust, then that's it. Basically, at least yeah, you're set. At least because they are also the family office. Also, what they do is just getting also money from people like either wealthy family or something. They also need to kind of take care of those their companies on the line, I guess, or on the hook. So that's why
Right.
they really need to make sure their investments are good and safe.
Yeah, they're
Yeah.
they're trying to protect the principal, and they want to make sure that the deal sponsors are trustworthy, and they're going to be, fiduciary responsible, just taking care of the
Yes.
money and stuff like that, So yeah,
Yeah.
protection of principal is number one.
Yes. Yep. Then yeah, I guess for the next part is like the closing. Do you know like how long did it take from LOI to closing on these two units?
So generally, from LOI to closing is probably about 75 days. I think in the Irving deal, it was a little longer just because we gave them a couple extra weeks. They were working on a 1031 out of
Oh,
it,
yeah.
and asked for a little bit more time. But generally, in the contracts, it's 60 days. Commercial usually 60 days, maybe 75 in the middle of COVID, but then with like maybe a 30-day extension for any issues or require, you might need a little more time with the lender. If it's agency debt nowadays, seem to be taking a little longer. So, but that's pretty standard, was maybe 30 days for due diligence or 21 days or whatever, and then 60 days to close. But that's from PSA. So from LOI, it may take going back and forth with the attorney a week or two to go from LOI to PSA. So,
Okay.
um, you may have another extra week, so until it's signed, until the PSA is signed, generally you're still a little on edge.
Yeah, because I think it's not tied up under a
Right,
contract.
exactly.
It's
Anything can happen.
LOI. Yep. Yeah, if someone maybe a private equity comes into the picture, then offer you a lot more. Yeah,
Yeah,
things can
there's
change.
always there's always something.
Yep. Okay, I guess like this is the time that we ask the final five sizzling questions. So number
I'm
one,
ready for it.
yes. So I think you shared about the lessons learned on the due diligence. So any other lessons learned that you want to share our listeners in terms of deal analysis, capital raise, financing, or yeah, closing?
Um, Maybe just, from my own personal experience, I found that you know, partnering with people that have a similar mindset and a similar goal, and working as hard as you can to add value to those types of people is something that's helped me a lot in the journey, going into commercial real estate. So, just keep an open mind about how you can add value into somebody's life that is doing larger deals or doing deals that you want to be a part of or something like that. That was something that that really helped me grow in my going buying real estate. So
Mm-hmm. Nice. Then yeah, number two is any recommended books.
recommended books. I really enjoyed The Go Giver.
Oh, yeah.
I think it's by Bob Berg. The Go Giver kind of talks about that mentality of, just trying to add value to other people.
Yeah.
I would say there's so many books out there to read, honestly, but that is, that's a reasonably short one. It's like kind of in parable form, so it's an easy read. If you're wanting to start out, it's like 100 pages or so. So that's a
Yeah, I
good
have
one.
also,
It's a good one to
yeah.
start with.
Yep. I have also that book. Then what I did also is like I have my daughter, because in exchange of, let's say, because she's requesting for something, I told her like, oh, just read this book, then I'll give you what you're looking what you're asking for. Then she okay, like just kind of give me maybe like a book review or something. So because I think the good is with the Go Givers, like, yeah, it's the value basically that you give out.
Mm-hmm.
You're giving value and stuff. So hopefully I could get her like at least at an early stage, try to have her learn like all these good values. And you're here you're born here, basically, like at least try to help out, be good something, like have a contribution in the world
For
or
sure.
something. Yeah.
Yeah.
Okay, then then any recommended podcast or YouTube that you're listening right now, or you would recommend?
Yeah, sure. I really enjoy Tim Ferriss podcast,
Okay.
the Tim Ferriss show, which is, not not always commercial real estate related. That's just, kind of big picture stuff. He has a lot of professionals and kind of the best in their fields is what he kind of calls it. And then as far as podcasts, I'd recommend your podcast.
Yeah.
Starting out, so and if you're able to get people on here that have, can share good content and stuff, that's really, really important, and can really streamline somebody's, getting from not, maybe sophisticated, or, a little bit, and you're, a little dangerous, and kind of going to the next level, right? If you're buying a single family, then you can get to, get a multifamily, or, if you don't have any, maybe you can get a single family, or, you have 50 units, you can go to 100 units, or whatever that is. So, whatever podcasts, there's a lot of good podcasts out there. The, top three, commercial real estate podcasts, I think, on, iTunes or something. They're all going to have like really great content, honestly, really, really good content. And really it's just going to come down to, who you get along with, or who you kind of vibe with. If you're listening to one podcast and it doesn't resonate with, the way that you maybe think a little bit, you can find one that, maybe resonates with you, or their story resonates with you a little bit in your story, and you kind of, can learn something from that.
Oh, nice, nice. So the number four is this is the time to promote yourself. So for everyone out there, like, what's your acquisition criteria for multifamily in terms of location, number of units, class that you're looking, so that yeah, if they have anything going, then they can reach out to you and your team and bring the deal to
Sure.
you. Yeah.
So generally we're looking for 100 units plus in better submarkets in DFW, and pitched roof, individual HVAC, 1980s plus, B class properties in B class neighborhoods. So DFW, I'm not sure, your listeners may be all over the place, but there may be some other submarkets and major metros, but we're kind of established in DFW, so that's where we're buying.
Okay, sounds good. Then what's the best way to contact you?
So people can email me or call me, text me, anytime. My email is Daniel, DANIEL, at LM Max Realty, lmmaxrealty.com. And then my phone number is 319-830-9034. And people can reach out, they want to text, call, or anything. I'm generally available on an open book, so I don't mind if you want to reach out or anything like that, I'm always open to talk about commercial real estate, especially right now. I feel like there's lots of uncertainty and a little fear in the market. So, people, want to, hear about DFW or why I'm still, feeling a little bullish in DFW, then call anytime.
That's nice. Thanks. I guess
Sure.
I think that ends our show. Thank you again for Daniel for being a guest in the show. Appreciate all the gold nuggets that you have been provided.
Yeah, thanks for having me on here, Jeff. I really appreciate it.